Let me ask you a question. Do you know how much house you can really afford in California right now? A lot of first-time buyers scroll listings, fall in love with a home, and then they find out later it's way outside their budget. That's frustrating, so today I'm going to break it down in real numbers, real examples, and simple step-by-step plan to help you figure out what works for you. And if you stick around to the end, I'll share a bonus tip that most buyers never hear, but it can save you thousands of dollars. Let's start with the big number. The average price for a single family home in California is around $800,000 statewide. In some cities like San Francisco or San Jose, that number can easily be over 1.3 million. In others, like parts of the Central Valley, you might find homes closer to 400 to 500,000. So let's use 800,000 as our example today. If you put 20% down, that's $160,000. You would be borrowing $640,000. At today's interest rates around 6.5%, your monthly payment, including mortgage, taxes, insurance, could be around $5,200 to $5,500 a month. Now, let's look at another option. What if you only put 3% down? About $25,000. Your loan amount would be around $776,000. At that same interest rate, your payment would be closer to $5,800 to $6,000 a month, including taxes, insurance, and monthly mortgage insurance. See how the numbers shift depending on your down payment. That's why knowing your numbers up front is so important. But here's the truth. Your monthly payment is actually made up of several pieces, not just one number. There are 4 main parts you need to know. The first one is principal and interest. This is the biggest piece. Principal is the money you pay back towards the loan itself. Interest is what the bank charges for lending you that money. For example, if you buy an $800,000 home with a 20% down payment, your loan is $640,000. At today's interest rate, that principal and interest alone could run you around $4,100 to $4,300 per month. The second is property taxes. In California, property taxes are about 1.25% of the purchase price of your home each year. On an $800,000 home, that's about $10,000 a year. When you break it down monthly, that adds another $835 per month. This is money you can't skip. It's required, and it goes to fund schools, roads, and city services. The third thing is homeowner's insurance. This protects your home from disasters like fire, theft, damage. Insurance costs can vary depending on the size of your home and the location, but a safe estimate is about $150 per month. Some areas with higher wildfire risk can be even more expensive, so it's important to ask for a quote early. Number 4 is mortgage insurance, or MI. If you put down less than 20%, you will likely have mortgage insurance. This protects the lender in case you default on the loan, and it usually adds between another $200 to $400 per month. This exact cost depends on your credit score, your loan program, and how much money you put down. The good news, this cost isn't forever. Once you build up enough equity in your home, you can often remove it. So here's the big takeaway. When someone says, my mortgage is $3,800, that number is usually just their principal and interest payment. By the time you add taxes, insurance, and possibly mortgage insurance, the real cost monthly could be significantly higher, more like $5,000 to $5,200. This is why knowing the breakdown matters. If you only plan for the loan payment but forget about taxes and insurance, you might end up with a monthly payment that's way higher than you expected. Now let's talk about how lenders decide what you can actually afford. We look at something called your debt to income ratio, or DTI for short. Don't worry, it sounds more complicated than it really is. Here's what it means. We add up all your monthly debt, things like car payments, student loans, credit card minimums, and then we add your mortgage payment. Then we compare that total to how much money you make every month before taxes. That percentage is your DTI. Most loan programs want your DTI to be no higher than 45% to 50% of your income. That's the safe zone lenders feel comfortable with. Let's look at a simple example. If you make $10,000 a month before taxes, your total debts, including your new mortgage, shouldn't be more than $4,500 to $5,000 per month. So let's say you already have a car payment of $500, a student loan of $300, that's $800 right there. That means the maximum mortgage payment you could qualify for would be $3,700 to $4,200 a month. This is why pre-approval is so important. Without having a lender run your numbers, it's almost impossible to know what you really qualify for. I've had clients who thought they could afford way more, but their other debts brought their DTI up too high. On the flip side, I've also had people who thought they couldn't buy yet, but once we ran the numbers, we found out they actually qualified for a lot more than they had expected. Bottom line, your DTI tells the lender how much risk you are. It's like your financial report card. Keeping your debt low and your income steady puts you in a much stronger position to qualify for a home you want. So what happens if you hear these numbers and you think, wow, that feels way too high for me? First off, don't panic. That's a normal reaction. The good news is there are smart strategies that can help make buying in California more realistic. First-time buyer programs. California has special programs designed for people just like you. These programs can let you buy a home with a much smaller down payment. Some even help cover part of your down payment or your closing costs. For example, instead of needing $160,000 for a 20% down payment on an $800,000 home, you might only need around 3% down, or about $24,000 with certain loan programs. That's a huge difference. Programs like CalHFA even offer assistant loans that you can pay back later, so you can get into a home sooner. Another trick is buying down your rate. You can sometimes use seller credits or your own funds to lower your interest rate. This is called a rate buy down. Even a small drop, say from 6.75 to 6.25, can save you several $100s every single month. Over the course of a year, that would mean thousands of dollars back in your pocket. And sometimes sellers are willing to give you this credit to make the deal happen. Here's a house hack. This strategy is getting more and more popular. House hacking simply means renting out part of your home to help cover your mortgage. That might be a spare bedroom, an accessory dwelling unit, what we call an ADU, if the property has one. Imagine your payment is $4,500 a month and you rent out a room for $1,000. Now, your personal share of the mortgage feels more like $3,500. It's a small way to make a big payment feel smaller. Another thing you could do is start smaller. And here's a big one. Your first home doesn't need to be your forever home. Maybe instead of a single family home, you start with a condo or a townhouse. These usually cost less, which means lower monthly payments and a smaller down payment. Once you build equity, you can move up later. The most important step is just getting into the market so your money starts working for you instead of going to rent. Here are some mistakes I see first-time buyers making. Shopping before knowing their budget, forgetting about extra costs like closing costs and repairs, waiting for the perfect market moment, thinking they need 20% down. Avoid these and you'll save yourself stress, time, and money. Here's a question I hear all the time. What if I buy now and prices drop later? Here's the thing. No one can perfectly time the market. Prices might dip slightly, but in most parts of California, long-term demand keeps value strong. The real question is, what happens if you wait? While you're renting, you're not building equity. Meanwhile, buyers who got in early are already paying down their mortgage and gaining value. And remember, you can always refinance later if rates drop, but you can't go back in time and buy a home you missed out on. So let's recap. California home prices are high, but you can plan smart with real numbers. Your monthly payment includes more than just the loan. Pre-approval is the first step to shopping with confidence. There are strategies to make it more affordable, and don't wait for the perfect moment. Buy when the right home fits your budget and your life. If you're serious about buying in California, the best thing you can do is get pre-approved today. You can call or text or click in the link in the description to book a free 15-minute strategy session with my team. We'll go over your numbers, your options, and your plan. No pressure, just clarity. And if this video helped you, hit like, subscribe, and drop a comment below with your biggest question about buying in California. Thanks so much for watching, and I'll see you in the next video.